Kumar has given his bike for servicing. While he is waiting for his bike at the lobby of the showroom, he sees Mr. Khan looking at new bikes. Kumar walks up to him and peeps in from behind. "Ah, Mr. Khan, so finally you are going to purchase a bike. It's been long pending," says Kumar. Mr. Khan looks surprised and tells Kumar, "Nice to run into you, Kumar. You are just the person who can advise me about the right bike to choose." "Okay, sure. What kind of bike would you like to buy?" asks Kumar. Mr. Khan thinks for a moment and says, "Well, not one like an equity fund. I think I would rather buy a bike that's like a balanced fund." Kumar raises an eyebrow in surprise. "How can bikes be like mutual funds? What do you mean?" Mr. Khan explains, "You know, there are several kinds of mutual funds. You can think of your superbike like equity mutual funds. Equity mutual funds invest primarily in the stocks and equity shares of companies and aim to generate capital appreciation. Equity funds have higher potential to generate higher returns, but also carry more risk, which is what your superbike does. It has a much higher acceleration and can get you to your goal much faster. At the same time, it is much more risky." Kumar nods. He gets this analogy. Mr. Khan continues, "Then we have debt mutual funds, which invest primarily in debt securities, money market instruments, treasury bills, corporate bonds, etc. Debt funds aim to generate regular income and are less risky than equity funds. These can be compared to low-segment family bikes and scooters. They give great mileage. Also, the maintenance is comparatively less. It is safer, but doesn't have much power, so you get to your goal much more slowly." Kumar imagines himself on a scooter for a moment and then wakes up from the daydream. There is also a balanced fund, which is also known as hybrid fund, and it's for investors who want options for medium-term investing. Investments are in both equity or stocks and debts or bonds. It is like a bike which gives a decent mileage but also has better power for long rides. You could say a nice mix of both worlds, which makes it an ideal investment tool for 5 to 7 year periods. Both safety and reasonable potential for growth. Equity-oriented hybrid mutual funds invests between 65 to 80% in equity assets. Debt-oriented hybrid mutual funds invests between 75 and 90% in debt instruments. Kumar chimes in. "Ah, I get it. You want a bike that you can use around the city as well as go on some weekend long rides. Since balanced funds allocate funds in the right proportion between equity and debt, they are less risky than an equity fund. The equity portion will earn better returns and the debt part will earn steady returns at lower risk. It will have enough power to go uphill and will still give you a decent mileage," Mr. Khan adds. Mr. Khan says, "Also, remember there are many different kinds of balanced funds that you can consider. Balanced hybrid funds invest in a combination of stocks and bonds. A balanced hybrid fund has 40 to 60% in equities and balance in bonds. It is like a bike that is designed to deliver slightly more power than mileage. Aggressive hybrid fund. An aggressive balanced fund has 65 to 80% in equity and the remaining in bonds. It's like a bike that delivers much more power than mileage, but without being a superbike." Mr. Khan continues, "You know, we don't always travel in the town and off-road equally. It may differ from month to month. Similarly, there is a fund called Balanced Advantage Fund. Balanced Advantage Fund, also known as a Dynamic Asset Allocation Fund, invests both in stocks and bonds. The allocation into each of these asset classes is not fixed, but managed dynamically. It is less risky compared to other balanced funds. Allocation to bonds or stocks will change as per the fund manager's views." Conservative Hybrid Fund predominantly invests in debt instruments, 10 to 25% in equities, and 75 to 90% in debt instruments. It's like a bike which is mostly designed to deliver mileage, with just 10 to 25% emphasis on power. Kumar listens carefully and then says, "These funds sound great. There are bikes and scooters that you can buy for a few months with a guarantee of buyback, mostly for people who are visiting, etc. Are there any similar balanced funds you can invest in for a short duration, like 3 months to a year?" Mr. Khan replies, "Well, there is one fund called the Arbitrage Fund. They have a minimum investment of 65% in equities. Arbitrage funds carry no credit or interest rate risk. They generate return by simultaneously buying shares in the cash segment and selling futures in the derivative segment of the same company as long as the futures are trading at a reasonable premium. This scheme does not take a naked exposure to any individual company or an index, as each buy transaction in the cash market has a corresponding sell transaction in the futures market, thereby reducing risk. This means that for every purchase, there is already a sale ready at an agreed price at a future date. Therefore, the risk is mitigated. Just then the salesman comes in and asks Mr. Khan, "Sir, have you decided on which bike you would like to go for?" Mr. Khan responds by saying, "Yes, I will go for a balanced bike." The salesman looks at him confused. Kumar chips in saying what he means is that he will go for a bike in the 150 to 200cc series. He points at a bike displayed at the other end. "Thank you, Kumar," says Mr. Khan, and Kumar responds by saying, "No worries, Mr. Khan. Now you can help me decide which balanced fund should I invest in." They both laugh while the puzzled salesman looks on.